A very good afternoon, good morning. Welcome to HYCM's online trading workshop with myself, Giles Copland, the Chief Currency Analyst here at HYCM. I do hope everybody is doing well, and I look forward to taking us through this workshop. Now, as we get going, let me just explain that this workshop is to help you identify a key currency pair for trading in the coming session. Just to be clear that the whole idea of this webinar is that you look over my shoulder, someone with a professional trading background, and you see how I go about making decisions in the market. And then the idea is that you learn from the process which I take in order to make better trading decisions for yourself. Now, as a Chief Currency Analyst here at HYCM, a key concept I teach aspiring traders is every day you're looking to back strength against weakness, particularly in the currency markets. So whenever you're trading FX, this is always the exact principle I use. It's simple, it's tried, it's tested, it's helpful. And just as a strong arm is against a weak arm, what I'm looking for here is to pair a strong currency against a weak currency. So that's the principle which I use in order to make trading decisions. Don't forget, you can ask me questions at the end of this webinar, so please do ask any questions, put them in the box, and I'm happy to go through them. Now, today is just worth running through what we have going on. We have a Georgia state runoff in the US, and this election in Georgia will decide who controls the US Congress, whether it's a Democrat Republican split, or whether it's a Democrat blue sweep with the Democrats controlling both the Senate and the House of Representatives. At the moment, the Democrats are in charge of the House of Representatives, and if the Georgia vote goes their way, which it seems that it has, there is anticipated to be what's called a blue sweep. Now, a blue sweep is when the Democrats are in charge of all the US administration and Congress is dominated by the Democrats. Now, what this means is that the Democrats are able to put through their policies much more easily if they control both the Senate and the House of Representatives. That's the bottom line. Now, what that means is a few things. So on the negative side, if we just go, I'm going to go over to my charts. On the negative side, what it means is you can see on the start of the year, we had a heavy sell-off in S&P 500 markets. Now, the reason for that sell-off was that if the Democrats do gain control of the Senate, will that mean higher taxation and deeper regulation on tech stocks? That was the fear. That's why we saw a sell-off. Now, that dip was bought. So what's happening at the moment is the market is trying to decide which narrative to go with. Do they go with the fact that the Democrats in charge will be a large US stimulus bill? Remember, Joe Biden said that the $900 stimulus checks would just be, a down payment, and that there were a larger $2,000 payment checks coming to people in the new year. If the Democrats are in charge, that stimulus package, that fiscal package from the US administration looks very likely to come. Now, that's positive for stocks. However, what's negative for stocks, if Democrats are in charge, then that means a more highly regulated and deeper taxation on the US stock market. So that in itself is potentially negative. So that's what's going on here. That's the battle between the two narratives. Now, looking at the S&P 500 futures, you can see, look, that uptrend is in place. See, here we have a Harami inside bar pattern. So a break of this pattern here, so a break of this higher with stops running below here and trading the stop below the daily could be one option. Now, the market's still trying to work out how to respond to this potential Democrat blue sweep. Now, looking at European equity markets, look, we see European stock markets are surging forward. The FTSE 100 is surging forward. Now, I initiated a trade in my own personal account. Again, this is not trading advice, but hopefully it helps you understand this. So I initiated a long trade in the FTSE 100 this morning on the break of this trend line. Very simply, that with all the Brexit negotiations going on, investment was not being put into the UK economy because investors feared putting money into the UK economy because of Brexit and the uncertainty it entails. Brexit has been agreed, a deal has been struck, so life in some ways carries on as per normal for the UK. So that's why this is, I saw this very good, potentially strong opportunity in the FTSE 100. Now, stay above this trend line. Trend lines can be very simple ways of trading. And it was just, this is a daily chart. If you go to the weekly chart, you'll see this on the weekly. This is a weekly time frame, which I entered on. You know, we've got a break of this trend line, stay above the trend line, bulls are in control, looking to target that 7,600 level. So I'd anticipate that over the course of the next 3 to 6 months, I'd anticipate the FTSE 100 moving up to that 7,600 level. So that's what I'm looking for. That's why I entered long in the FTSE 100. Stay above, bulls in charge. Now, if I fall below the trend line, I'll exit the trade. So this is a trade where I'm just staying above the trend line. And if we get a close above this on the daily chart, that will be a good confirmation. So some traders might just wait for a close on the daily, get a close above. They might enter, stops running about 6,450, going for that 7,600 level. Now that's on the US stimulus package. Now, what might happen, and this is the bit that I'm unclear of, and all investors are unclear, is how the US stock market is going to respond to this potential Democrat blue sweep. At the moment, yields are surging higher, dollar is dropping heavily. We've also got commodities rallying higher, strong, a little bit of downside in WTI and Brent crude, but that's to be expected after Saudi Arabia's surprise cut of 1 million barrels per day. So there was a strong move higher, and some of those strong move higher just seeing a bit of retracement, which is what you'd expect. But European equity markets nicely high. S&P 500 markets seeing some bids on the day. So the futures markets in the S&P 500. You know, seeing bids in pullback. So the day is very, you know, minus 0.16%, very, you know, midway, not much going on day, but look out for potentially strong gains depending on how the market reacts. But they're the two narratives. Vaccine hope coming, large US stimulus package is bullish for stocks, but some fear Democrat blue sweep will mean selling in US stocks because of higher taxation and higher regulation. That's the atmosphere that's going on. Now, in terms of key data that we have coming up, we only have ADP employment data out of the US, not very significant in the wider context of today. And we also have the FOMC minutes coming up later tonight, 7 o'clock. So that will be important for the dollar. So any dollar moves are likely to be accented by those FOMC minutes. The dollar index itself, there's very important reasons for dollar weakness at the moment. The reflation trade, the fact that the US economy is looking like being overtaken by Europe and China. China set to overtake the US economy by 2028, according to one report I read. We also have large amounts of quantitative easing. We have the reflation narrative. Global growth tends to be weak for the US dollar. So as a whole, all of this means that many analysts are very bearish on the dollar, and any retracements in the dollar index at the moment can be considered suitable for shorting. In the near term, we have to be aware that this dollar index is now sit in this sort of key support level around this level here. Okay, so that's something to be aware of. And you would expect potentially some people taking profit and moving higher. I took a short on the dollar index at the end of last year, just into this support level here. I shorted from around this 90.72 level and moved, took profit around this 89.60 level, just as we move into that support level. Expect profit takers. If that level breaks lower, then expect more continued heavier selling. So that's something to be aware of. Now, in terms of oil, you would have noticed some strong upticks in oil yesterday. Now, the reason for those strong upticks in oil yesterday was very simply because Saudi Arabia surprised the markets and said, look, we have got a 1 million barrel per day production cut for February and March. So that's very supportive for oil. So we'd expect any retracement back down to that 49 level. See, it's a daily pivot point. It's a big round number. Anything around 49.10 can be considered suitable for going long, looking at taking profit at that 50 level. So 49 to 50, a little 100-point pip stops just running below the lows there. So any retracement back down to that pivot point there can be considered suitable for buying US oil on the positive narrative that's going on about risk on, as well as the production cuts from Saudi Arabia. So that's one to keep a careful eye on. In terms of currencies, the key currency today is the Australian dollar. Now, just taking a look here, you can see, look, this is important. Equity markets are higher. Commodity markets are higher. We're seeing bond yields higher. This is telling us that risk is very firmly on. Looking at the currency space, we see that the commodity currencies are all higher. Aussie, CAD, New Zealand dollar. CAD's showing a bit of weakness at the moment, but those oil prices should support CAD on the day. But particularly the Aussie and New Zealand dollar, both Australia and New Zealand have done a fantastic job at containing the coronavirus. So they do stand to gain, and particularly when the world gets going again, Australia and New Zealand dollar have a head start. They are pro-cyclical growth currencies. Australia dollar often traded as a proxy for China, so a global growth recovery is no surprise that we're seeing strength in the Australian dollar. We're also seeing weakness in the safe havens, Japanese yen, Swiss franc, broad safe haven weakness. We've got some lockdowns taking place in Japan, Tokyo about to be declared a state of emergency. Difficulties going on there for the Japanese economy with COVID-19, so all of that further weakens the yen. So some good trades to be looking at today is Aussie US dollar longs, Aussie Japanese yen longs, New Zealand US dollar, and New Zealand dollar Japanese yen longs. So that's why, for me, my dominant currency sentiment pair for trading today for this session is the Aussie US dollar from 0.7750. Any retracement back down to 7750 can be considered suitable for buying and looking for taking profit just up at that 0.7800 level. So again, a 50-point potential on the intraday basis, looking for a drop down to 0.7750, looking to take profit at 0.7800. That is what makes sense for the order of the day today. So that's definitely something to be keeping an eye on as we move on further and deeper into the session. So that's the dominant currency sentiment pair. The main risk of this outlook is if we see a lot of dollar strength, or we see these strong yields. Usually, just to be aware that usually like 10-year yields moving higher, usually that would result in the dollar index moving higher as well. So the bond yields moving higher, normally that would result in dollar strength, but we're seeing continued dollar weakness. So if we see some dollar strength come into the market, remember we're at that key support level, then that could potentially invalidate this outlook, but you need to see a wider movement. You'd see a sharp sell-off in stocks. So if you saw a sharp sell-off in the US stock market, that would invalidate this outlook. Otherwise, this retracement back down to 0.7750 is a decent place to look for going long in the markets. Now, I'll show you one. If you have any questions, please do put the questions in now. Aside from that, I'll show you one other long-term trade I've entered recently. I've showed you the FTSE 100. I've also got the Aussie yen. I'll just run this by you. It's a trade I've entered. I've entered two entries, and I'll show you one. So the first entry, you see this head. So shoulder, head, shoulder. That's a head and shoulders pattern. Left shoulder, right shoulder, head. The way you enter the head and shoulders is you take a break of the neckline. So you can see here the neckline is here, and so the entry was on the break around that 77.80 level. I entered around that level on the break of the Aussie Japanese yen. That's one trade, but there's another trade that I've just entered, which is a bigger time frame, and this is, can you see that very large head and shoulders pattern? See that? Left shoulder, right shoulder, head, neckline. We've got a break of the headline and head. Now I entered on this level here, 79.55. Now there is still time to get in on this, because this trade would be one that I'm expecting to hold for like 3 months, 6 months. And I'm looking to go long here on the break of this neckline. And the target with a head and shoulders pattern is always the height of the target. So you see the height of this target is like it's 60 up to 77, so roughly 1700 points. So entering here from around, around 80 up to 1700 is around 97, call it 96. So that's the ultimate target, is 96. So you can see here, as long as price is above that trend line, you can stay in. So I entered here, my stop is running nice and tight, not nice and tight, nice and out the way at 73. I'm not trading with leverage, I'm trading an unleveraged position. Fantastic. So now if price breaks back below that trend line, then I'll really reconsider the position. Okay. So if it's very, very difficult, then I would look at potentially exiting. Otherwise, looking for a run higher. Reason for the trade: global growth recovery. If the globe recovers, stock markets will recover. Australian dollar will be a big beneficiary. Yen will also weaken. So that's the reasons for that trade there. Yeah, Nura, happy new year to you. And yes, let's look at gold futures. If you're just taking a look at gold spot price, what's going on there? Now, gold has a lot of reasons for strength at the moment. Now, one thing to be aware of in gold at the moment is these 10-year yields moving higher is a negative for gold, right? So when yields move higher, that puts pressure on gold. Also, we had that strong sell-off in gold at this level here. So this is always going to be a key level for taking profit for, for profit takers, key level of resistance. So it's not surprising to see a bit of profit taking going on there. Now, what happens with gold will depend on what happens with the US dollar. If those 10-year yields start to strengthen the US dollar, then gold will be pressured and expect to move back down to this 1900 level. I would expect buyers on a first test of this 1900 levels. You see that technical breakout. We also have strong ETF buying has recovered. So the ETF buying that stopped before Christmas has now picked up again. We have inflation narrative. The large QE stimulus packages should benefit gold. So I'm expecting gold to be a beneficiary of this blue sweep. Now, even though we've got some near-term resistance there, I'm expecting buyers on the dips. I had 3 gold positions before Christmas. I closed 2 of them out as we went into key resistance levels. But I have a final position running about 1870, 1880, which is below that trend line. So I've just moved that to break even. The FOMC minutes, Nora, will be key for gold. If the minutes are more bearish, that the Federal Reserve is seeing, if the Federal Reserve is seeing bearish reasons, then you'd expect that to further support gold. Nora says she was short gold. Well, short gold does make sense with the rising 10-year yields, Nora. The difficulty here is we just have to see how the US markets react when we get into the US Open. So you can see a little bit of profit taking here in the dollar. We'll have to see what happens with the US Open. No particular change in sentiment at the moment. There's nothing here going on. Short makes sense because of that. You just got that key demand level. Whenever you have a key demand level like that, you would expect a bit of profit taking when you move into the level. Similarly, you'd expect some buying here with that strong demand level. So any retracement back down to there, you'd expect strong support on a strong demand level. So I am still bullish on gold, but we'll have to see what happens with these US 10-year. The further they rise, then that makes it more difficult for gold to keep rising. But we also have to look at inflation expectations. So you can see here that as long as inflation is rising and inflation expectations are rising, then that keeps the yield rise in check. If inflation starts to drop, but yields still rising, then that will impact the dollar. So there's a few moving parts with gold at the moment, Nura. But have to wait to see how the US reacts to this Democrat sweep. That's what's really going on here. So we'll see. But so if you're short, you want to just keep a tight rein on that. Longs from 1900 makes sense. FOMC minutes the key risk. If the Federal Reserve say, we see reasons to be continually bearish, we're going to do whatever it takes to support the US economy, and if the market reads those minutes as bearish, then that's weakness for the US dollar, upside for gold. So we're into a very, very potentially volatile day. So hold on to your hats. Noura, I hope some of that helps. Okay, folks, there's plenty of food for thought there. I hope a lot of that helps. Do come back next week. Let me know how you're getting on. Let me know your questions and what's going on. I look forward to taking you through things. I hope you all have a very good rest of the week, and I wish you a very good week, and I look forward to seeing you next week, and let me know how things are going. Thanks, everyone now. Take care and goodbye.